This next fellow, probably not, but he does remember, former CBO Director Douglas Holtz-Eakin. Doug, you know, people forget. We've been a lot higher than this. But again, it's what you're used to. A lot of people, including the young traders who dominate Wall Street, don't know that. This is all they've known, and they get alarmed, should they?
No, I don't think so. Look, it's good news when interest rates go up if you're an investor. It's bad news if you're a borrower. That's always true.
Right.
But not all interest rate increases are created equal. And as you pointed out, this one comes because markets and the Fed recognize the economy is stronger. And so if you've got higher interest rates, you're also going to have more money. That's a very different story than if the Fed's jacking up rates to slow down the economy and they're going the opposite direction.
All right. The other worry is they go even higher and faster higher because of all the debt we have and financing it through the issuance of Treasury bills, notes, bonds, that sort of thing. Do you worry about that it's going to mean a big increase in just the cost of our debt?
No. We're not in a range yet where that's going to show up. It's something that in the big picture I worry about. We have too much debt. I'd like to see a lot of it go away.
We can refinance a lot of this.
We can refinance in it. We can sort of manage what we've got right now. So I think the thing to keep the eye on is how fast is the Main Street economy growing. If the Main Street economy is fine, the stock market will end up fine. If the Main Street economy is not fine, and it hasn't been, the stock market won't do well.
When you look at these anomalies between a 2-year and a 10-year, as narrow as it's been in years, some say that can preview some not so pleasant things, a slowdown at the least, a recession at the worst. What do you think?
I don't think we're in the territory of a recession. There's some formal models of this to say the probability is something like a fifth or lower over the next 2 years. I think that's about right. I think the truth is we're coming out of a period of extraordinary monetary policy where market signals really got suppressed by the Fed. They bought up all the debt.
But do you think the Fed can get bypassed by this, that they, too, have gotten used to this? They created this 10-year zero-rate policy, even though they've tried to rebalance it halfway, I guess. Yeah. That they risk getting caught behind.
They risk getting caught behind. I think there's no question. But of the risks that you want to take right now, would you rather have the economy booming, there's no real sign of inflation yet, or do you want to say, oh, well, we're not going to get behind and cut it off too quickly? I think they'll err on the side of moving gradually and slowly.
So 2 or 3 more hikes this year?
I think something like that, yeah.
What about the inflation as you look at it right now out there? That you always want to be ahead of the curve, ahead of inflation. Don't get behind because that could be fatal and all that. How are they doing? How are we doing as a nation on that?
It's all about goods prices. Services inflation has been right where the Fed wanted it since the beginning of the recovery. So we've had this massive deflation in goods, largely traded goods, and as those firm up, the Fed will have to start to move. And so if they just watch those, they'll be fine.
What happens to housing in an environment like this? Normally, I've learned, I was surprised by some of these statistics, that housing is at its busiest when rates are actually climbing, not declining. So they're climbing a little bit now. Do you expect that to continue?
There are really 2 different things that are going on. One is the refi, rates start to go up. You think, last chance, I'm going to refinance my house. So we get a lot of activity from that. The underlying, construction and sale of new homes has actually been kind of sluggish. And there's concern that there really isn't enough supply of houses. That seems largely to be dominated by the coast, the New Yorks, Washingtons, Bostons, and San Francisco, Seattle, San Diego, where local laws make it hard to build, and that's driving up home prices.
The president and his tough trade talk with China and elsewhere. Tim Cook is going to be meeting with the president today, and he's concerned about it. Obviously, he sells a lot of stuff there, makes a lot of stuff there. Should he be worried?
I think there's reason for concern because we don't really know what the end game is. The administration never really said, this is what we want, and this is how we'll know when we get there, and that would be a great plan if you could figure it out. In the absence of that, you're sort of left thinking, okay, how does this end? And if you've got a big book of business associated with China, you have to be a little concerned.
When you were the Congressional Budget Office Director, how much did you weigh the stock market into your computations?
None.
Really?
I mean,
it was just gravy if it ended up being more revenue than expected? Right.
On the revenue front, there was one and only one piece that mattered. It mattered a lot. It was the taxation of options and bonuses, particularly in New York City. In the late 90s with the dot-com boom, all that money flowed in. And then when the boom ended and the dot-com bubble burst, the money didn't show up. It was one of the big parts of the revenue swing in the federal government. So we paid attention to that. But in terms of the health of the economy, I've always thought, make sure that people are getting up, going to work, getting a job, getting a raise. The stock market will take care of itself.
With that internet boom,
well, that was a very big deal.
That certainly helped make for surpluses.
That's how we balanced the budget.
Yeah.
And so when people say, "Oh, I want to balance the budget again," I say, "Well, be careful. How? Do we really want another bubble and bust?"
But that did it. Without that, would it have been done? Would we have had those surpluses?
No.
Really?
No, it was a huge, huge shift in revenue. Basically, you took all the revenue you would have collected in 2000, 2001, 2002, and you jammed it into 97, 98, and 99.
I remember it well. A little bit.
As do I. And 10% interest rates. All of it.
Doug, thank you very, very much. Widely respected on both sides. He is a genius with this stuff.